Welcome to the inaugural Biotech Capital Compass, a monthly newsletter launching this October for active investors and traders in biotechnology, with paid subscriptions starting January 2025. The author, Hartaj Singh, brings over 30 years of experience spanning drug development, hedge fund management, and biotech analysis as a highly ranked analyst. Let's examine the biotechnology sector's current position and the promising opportunities heading into the fourth quarter of 2024. Major January conferences in San Francisco, potentially neutral election impacts, and lower interest rates are all converging to create a strong environment for biotech by year-end. 3 ETFs, IBB, XBI, and BBC, offer investors broad exposure to capture the sector's expected strength from November through February. Gilead Sciences stands out with its strong pipeline, upcoming HIV approvals, expanding oncology portfolio, and one of the sector's highest dividend yields. Biomea Fusion recently shared plans to introduce its third clinical candidate, BMF 650, on an October 30th call, marking a key 2024 milestone alongside ongoing diabetes trials. Now let's look at the behavioral patterns and historical trends that shape the biotechnology sector's dynamics. The sector shows a clear seasonal pattern. September and October are historically weak due to fewer conferences and earnings uncertainty, while November through January typically delivers strong performance. 3 major healthcare conferences, JP Morgan, Biotech Showcase, and Digital Medicine Showcase, all converge in San Francisco each January, creating a comprehensive view of the healthcare landscape that drives deals and partnerships. This January conference season directly fuels increased M&A activity, as these events initiate many of the year's largest biotech deals and licensing agreements. This dashboard reveals that 2024's third quarter saw only 279 deals worth $11.2 billion, with M&A volumes down 32% year-on-year after peaking around 2021. The 2024 M&A market contradicts historical patterns, showing an unusually slow third quarter that contrasts sharply with the robust activity seen in prior years. Current 2024 deals emphasize late-stage assets and CNS technologies, while pre-2023 activity focused more heavily on riskier early-stage assets during a more favorable economic climate. Let's examine how the upcoming presidential election might affect biotechnology stocks under different policy scenarios. A Kamala Harris victory could expand the Inflation Reduction Act and increase Medicare pressure on some companies, while protecting orphan drugs and supporting mental health, oncology, and women's health sectors. A Donald Trump victory would likely bring a more business-friendly approach, reducing IRA drug pricing pressure and supporting mergers through less stringent antitrust enforcement. Analysts on Wall Street are generally neutral regarding the impact of either party on the biopharma industry. Now, let's explore how interest rate changes act as a catalyst for biotechnology companies, especially smaller firms. Lower interest rates send positive effects across multiple dimensions, reducing capital costs, lowering discount rates and valuations, shifting investor behavior toward growth, and improving funding conditions for smaller biotech firms. Here's the recommended investment strategy for positioning in biotechnology ETFs to balance risk and potential returns. The strategy uses a 50-30-20 ratio, allocating 50% to IBB for large caps, 30% to XBI for small and mid caps, and 20% to BBC for smart beta exposure. Q3 earnings in November, January conferences in San Francisco, potential M&A recovery, and continuing rate cuts all point toward a favorable biotech outlook through early 2025. Now let's spotlight Gilead Sciences, a stock with solid fundamentals and strong momentum heading into the coming months. Founded in 1987, Gilead pioneered HIV treatments that now represent 70% of revenue, while also developing hepatitis therapies, contributing to COVID-19 response, and growing its oncology franchise. This financial table shows Gilead's enterprise value at $127.8 billion, with revenue projected to grow from $27.7 billion in 2024 to $29.8 billion by 2027, and adjusted earnings per share climbing from 3.79 to 8.16 over the same period. While Gilead expects overall revenue growth of 1 to 4% annually through 2028, the company conservatively guides for flat HIV revenue in 2025 due to Medicare reforms, though this may prove overly cautious. The Inflation Reduction Act's drug pricing negotiations directly pressure Gilead's valuation, contributing to its lower-than-peer growth multiples, given the company's exposure through Biktarvy and Epclusa. 3 drivers power Gilead's 2025 growth: the expanding oncology franchise, preventative HIV medicines gaining adoption, and newly acquired seladelpar for primary biliary cholangitis. Gilead's HIV portfolio dominates with 70% of revenue and strong market share in treatment, while oncology currently represents just 12%, but is becoming a critical growth engine. Understanding Gilead's earnings forecasts is crucial, as the stock shows strong sensitivity to changes in forward earnings estimates. Gilead's projected high single-digit earnings growth stems from strong revenue expansion and disciplined expense management, despite the negative impact from Q1 2024 M&A activity. This chart shows Gilead's share price closely tracking forward earnings estimates. When estimates dropped, the stock fell, and when they rose in late 2024, the stock climbed. Forward earnings estimates directly drive Gilead's share price, with reductions causing declines and increases fueling gains, making earnings revisions a key valuation driver. Let's examine Gilead's development pipeline and the key catalysts in HIV and oncology expected to drive growth in 2025 and beyond. Gilead's HIV pipeline includes lenacapavir as a potential twice-yearly prevention drug, GS3901 as a once-weekly oral treatment, and novel antibody approaches like teripavilimab for resistant HIV. Gilead believes the preventative HIV market can grow well beyond today's 400,000 US users as long-acting options expand access and boost adherence from 50 to 60% to over 90%. Oncology advancements over the past decade now contribute about 50% to Gilead's growth, driven by cell therapy expansion and Trodelvy's use across more tumor types. HIV readouts and approvals expected in 2025, along with ongoing oncology developments, should drive upgrades to forward estimates and positively impact Gilead's share price. Gilead maintains a strong dividend with a 3 to 4% yield and annual payout around $3 per share, attracting both growth and income-focused investors. Analyst sentiment has improved significantly. 30% of analysts turned more positive over 6 months, and 35% raised price targets in the past month with no decreases. Let's wrap up by summarizing the investment thesis for biotechnology positioning and outlining what comes next for subscribers. January conferences, easing election uncertainty, and favorable macro conditions with lower rates all converge to create a compelling biotech opportunity from November through February. Over the next 3 months, expect in-depth analysis and stock recommendations, with the newsletter transitioning to paid subscriptions in January for even more exclusive insights. Finally, here are the comprehensive regulatory and legal disclosures covering disclaimers, risk warnings, and conflicts of interest for this newsletter. The author holds positions in Gilead Sciences, Biomea Fusion, and the XBI, IBB, and BBC ETFs mentioned in this newsletter, all subject to a trading blackout period for transparency.